somebody in the corner would strike out and say, I love the Lord, he heard my cry. I love the Lord, he heard my cry. I love the Lord, he heard my cry.
All right, welcome back to another episode of the Keep It 100 podcast. I'm Sam Steffen. I'm glad you guys are on. You guys joining us for today's episode. We had a great episode today. It's been one that I've been waiting for a long time. We were joined by Dr. Steve Teney. He was an economist, or he is an economist, and he was a college professor. And I like to think of him as like a mentor of mine. You know, he taught me quite a bit in school, and I still learn from him. You know, get to talk to him every once in a while. And it was great. You know, we had a lot of fun. We did have some internet and some audio issues, you know, going throughout the podcast. The second half, we were fine, but the first half, we kind of had some issues. So just bear with us. You know, we tried the best we could. But with that being said, go ahead and enjoy the video. We'll see you guys later. All right, perfect. So first of all, I just want to thank you for coming on. I'm super happy that I was able to get you on. This is a conversation I've been waiting to have for a long time. So thank you, first of all. Thank you for coming on.
Yeah, my pleasure.
Yeah, absolutely. So the first question I have, you know, I kind of want to focus on, you know, kind of the state of the economy right now with, you know, the recession and all this fear that's, you know, that's going on in the market. The first question, like for you is, I know you said this in class, like that you're an economist. So how long have you like been an economist and how long have you been in the market for?
I've been an economist since I graduated from graduate school, which is, you know, pushing now 35 years or so. And I've been in the market pretty much that same amount of time.
Okay.
At some level.
Okay, I got you. Yeah, and has that been quite a journey, you know, just kind of getting all that experience in from now until then?
Well, yes, I mean, you see a lot of different things. You see a lot of market cycles, and I was a financial analyst when I first started working. I worked as a financial analyst, and so I approached the field from a different perspective. It was more applied as opposed to theoretical. Graduate level economics is highly theoretical. It's very mathematical. Some people would say there's no relevance when you get to the PhD level. I don't know that that's really true, but it's pretty specific. It's not really related at that theoretical level. It's not really related to the day-to-day activities of people doing applied research and trying to figure out whether a stock is a good value or something.
I got you.
I don't mean to diminish the field that the theoretical models that are developed now by a lot of the people that are investments are frankly, a lot of these people have physics and pure mathematics backgrounds. Those are highly sophisticated mathematical models, mathematical statistical models that are trying to project future returns and so on, events, scenarios, and so on in the market. And those aren't really relevant for most people that are just trying to pick stocks or build a portfolio because they don't have the background, they don't understand the material, number one, and number two, it's not available to them. You just get the results of the model. Model might say, hey, you know, increase your percentage in fixed income by 5% or something like that. And
Right.
You do it by looking at what would be a good buy. You don't have any idea really why you're doing it other than the fact you were told to do it.
Mm-hmm, right. You know, there's a lot of other stuff besides just like picking stocks and like, you know, doing basic research that goes into that, you know, kind of stuff, you know, the equation,
That's right.
market patterns, and, you know, there's just a lot that goes into it. How do like the Fed's decisions on rate hikes and, you know, money printing, how do they like affect citizens, like specifically in like the poorer and more middle class?
Well, other than driving up interest rates for mortgages, car loans, and so they won't affect credit cards too much. Those are usually locked in for a period of time, but obviously over time they would drive those up.
Mm-hmm.
I think the biggest, you think back and look at the Fisher equation, which tells you that nominal rates are a combination of expected inflation and real interest rates. The real rate's not observable, but inflation certainly is. You can infer the real rate. But anyway, nominal rates being driven up like that is going to make everything more expensive, and so many things are tied to nominal interest rates.
Gotcha.
Present value, financial asset prices and everything, values. So for people that are trying to buy things on time or credit, other than the inflationary effects, which are obviously felt because interest rates are going up, driving up the cost of borrowing, but all the price indexes and cost of goods, when they see interest rates going up, people assume that everything else is going to go up in price, and of course it will, probably, high likelihood anyway, statistically. So you would expect the cost of pretty much everything to go up.
Well, so like how long do you think like the market crash recession is going to pan out for?
Well, I don't think it's a crash, and it's really hard to say. My crystal ball isn't any better than anybody else's. I think my guess is that since monetary policy operates with a lag, and it's the same with fiscal policy, really. I think after the first year, I think things could dip a little bit, particularly because there'll be some selling going on in a couple of weeks, I suspect. How severe a contraction? It's really hard to say. Maybe it really depends on the labor market. A lot of lower end jobs. There's a lot of demand for labor. There are some higher end jobs that are getting laid off. Tech jobs and such. The tech companies are getting beat up pretty badly.
Yeah.
I don't think by the end of next year, though, things should crystallize. I don't think that if it's a recession, I don't think it'd be terribly severe. I think it'd be a slowdown as opposed to a recession. And I think perhaps by the end of next year, this time next year, things will crystallize a little bit, and things will start to pick up. Remember, we have an election year coming up in a year from now, and typically the economy does fairly well in election years. So, and of course, Congress and politicians will do everything they can to stimulate the economy with the so-called political business cycle. So whatever contraction that I think is going to happen, I think it'll be relatively minor. Again, surprises happen in the marketplace and nobody knows for sure.
Yeah, I mean, like you said, no one can really, no one can predict the markets. I mean, it's impossible,
If somebody tells you they know what's going to happen, turn around and run away from them, because
you got to run away from those people. Oh yeah.
Yeah,
like you said, it's like the labor market right now too. A lot of jobs are, there's a lot of layoffs going on, a lot of hiring. I actually got laid off. I was working at Custom Pack over the summer and kind of at the end of last school year. And this summer I got laid off there. They were super low orders, just super low. I don't know what the cause of that is, but it kind of happened the same time, all of this stuff started to play out. And I know there's a few other places like that are in the same, kind of problem. They have to lay people off and cut hours and cut positions. And I think, yeah, like you said, that's a huge part of it. And typically what I've heard, and I mean, this could be accurate and inaccurate, I've heard like 12 to 18 months is usually kind of the range they say. Typically, is that pretty accurate? Or is it just kind of like depend?
It's reasonably accurate. I mean, it depends on some other variables, but that's a reasonably accurate length of a contraction. They're typically a little shorter than that. I think the average recession might be more like 9 to 12, but if you have a 9 to 18 month window, that's probably going to cover most of them historically anyway. If you want to look at one of the better indices, there's a couple of indices to look at to kind of give you a clue as to what might happen in the future. One of the better indices is something called the Baltic Dry Index. It's basically a transportation index. If you tend to look at transportation indexes, they kind of give you a pretty good idea of what's being shipped. And now, being shipped is manufactured goods, it's not services. But it does give you a pretty good idea of what's being manufactured out there, what's being sent around the world. And obviously, if that index is going up, that's usually a good sign. If it's or stable, that's not necessarily a good sign it's stable, but it's certainly not either a terribly bad sign. But if the index is falling, it's not good.
Right.
There's some other indicators that you could look at, but transportation indexes are they're good signs. They help you to kind of read the tea leaves a little bit.
That's very interesting. I mean, that makes perfect sense now that you say that. I mean, yeah, I'll have to look into that because that's very interesting. But do you think there are ways that people can like benefit from like this, like stocks falling, recession? Like, do you think people can come out of that like green?
Oh, yeah, absolutely. If your time horizon's long enough, yeah. There's been no asset class that's performed historically better than stocks, since basically we've been keeping track. But you have to be careful how you interpret that statement. It's, you're looking at 5-year periods, 10-year periods, what class of stocks, are they mid cap, large cap, and so on, small cap. But for most people, for the long run, certainly younger people that are my age, older people, you have to have stocks in a portfolio, but you have to be careful what you have in a portfolio. For somebody your age, you should be highly invested in equities and not be worried about this so much. You should be looking at this as a buying opportunity, but you have to do your research. You can't blindly go out and throw money at the stock market. You really have to do your research or work with somebody that you trust. Some people don't like to do that. They don't like to pay for the services, but it's like anything else. You pay for what you get. If you think you're an expert and you just don't do very well, maybe you ought to look at some professional help. But yeah, no, I think I'm invested in stocks. I'm not 100% invested. I wouldn't recommend it for somebody my age. But you need them. Older people need them for growth. Younger people need them for growth. You don't know what the world's going to look like in 50 years. You don't know what the world's going to be here, really.
Yeah, right. Honestly,
we could blow ourselves up.
Right.
Yeah, the way the world's going, sometimes
you're right. Seriously.
but the point is that you have to. What younger people should be doing, if they're serious about this, is get out a piece of paper and write down, 5 or 6 different best case, worst case scenarios, and not just financially. Like, what would be the worst case scenario thing in the world? Well, it ends. Okay, well, then you don't have to worry about it. But what if there's some kind of apocalypse and paper money's no good? What do you do then? Well, do I invest in cryptocurrency? Well, you kind of see how that's working. You have to think a little bit about this stuff if you're serious. Anyway, getting back to what I was saying, a well-constructed portfolio with equities is your best defense. But you should always have at least a little bit of fixed income. For somebody like you or younger people, go out to treasurydirect.gov and buy yourself, 5% worth of TIPS. Treasury inflation protected securities, because they buffer the equity vagaries, which are bound to happen. And the other thing is you have to keep them for maturity, and that's okay. You get your principal back, you get the inflation back. There are tax problems with them. You got to be aware of that, so research that. But everybody ought to have a little bit of that. Everybody ought to have a little bit of gold. I don't have any cryptocurrency. I don't trust it.
Yeah, I was going to ask you about that, especially with
it's highly speculative. Unless you're extremely expert in it, I would stay away from it. Frankly.
Right, and I mean the crazy thing is about it, it's not even regulated. There's no SEC regulation at all. Like
yes, and I would expect that to change. And I don't know if it's good or bad. I don't know if I want it. The whole idea was that it could be an unregulated asset class where you and I can exchange something, and there were no regulations on it, which of course would lead to some situations that maybe weren't all that great. But if you get regulation, then that's going to change the asset class considerably. So some people want that, and other people don't want it.
I mean, the crazy thing is you can see, like, I actually watched this video on YouTube, and this guy created a cryptocurrency just to like show people like how easy it was. And it's like, anyone can just do this because it's not regulated right now. And I know they're working towards it in DC, they're trying to figure out regulations, but it's crazy. And especially, I'm sure you've heard about all the news, surrounding FTX and the big scam. I mean, it's crazy. Something new comes out every day. And it's like, this just gets worse and worse almost.
Well, that's frankly why I would avoid it.
Yeah. Yeah.
I guess I would stay with the tried and true asset classes. They've been up and down over time, but in general, they haven't failed, at least not miserably. But again, you have to have a sense of perspective, a sense of time perspective.
Yeah, definitely. I mean, I think that's great advice for anyone. Just don't, you gotta find what works and what doesn't work. And you just got to look at history and then do your research, obviously, and figure out what's good for you, and then go from there.
Yeah, just remember the old line that history doesn't repeat, but it rhymes.
Yeah.
So you can't expect things to be exactly the same. Otherwise, forecasting wouldn't be an issue. But again, if you do your research and look at general trends, historical trends, they often persist into the future. They may be somewhat different, but there is something to be gained from looking back at past trends.
Mm-hmm. Yeah, definitely. And so here's a hypothetical question for you. So if someone came to you right now with $1,000 and they kind of asked for your advice, what would you tell them to do with $1,000 right now?
Well, first of all, it depends on how old they are. And then it depends on the risk tolerance. But the general answer would be, let's say if you're 25, okay? I would put 90% into a good equity fund, mutual fund or ETF, an index fund. I wouldn't worry about that. It's only $1,000. And I'd put I think I said 90%. I put 90% in index, and then I think I'd put 10% into or maybe only 5% into a tips account. If you're older, you were 60, 55, 60, 65, near retirement, in retirement, I would certainly reverse those. I would look at maybe 20 to 30% in equities and maybe more towards fixed income or bonds. And bonds can get beat up. And this is not a good time for bonds. But again, I'd be looking at something that's a little bit more conservative, like the tips. Again, I want to state that equities, there's a place for equities in every portfolio. It just depends on your age, risk tolerance, and the type of equities. There's a difference between large cap growth stocks and small cap value stocks. Small cap stocks tend to do well when the economy's taken off. Well, if we're going into a recession and the economy begins to take off, then those stocks will probably do okay. And the large cap growth will wait, there'll be later cycle stocks. So that's what I'm saying. You have to go back and look at this. But that's what I would do. If somebody had $1,000, that's what I would say.
Yeah, I love that. And actually, I have
10,000 or 100,000. The percentages would remain the same.
Okay. And I remember in the last day of the investing class that we took, I think we have that same ratio. It was like 90 to 10%, 90% to 10%. I think I have that same ratio written down.
Well, it tends to work.
Yeah. Oh yeah, absolutely. And I mean, I've seen people go in with that strategy, and I mean, yeah, it works perfectly. I mean, for majority of the time. But what do you think are some like great long-term? So let's say for someone my age, trying to retire, save up for retirement, what's a good long-term investing strategy for there?
Well, again, I keep coming back to a solid, balanced portfolio that you adjust maybe quarterly, but certainly once a year. I wouldn't get too worried about looking at it every other day. I mean, that's ridiculous.
Right.
But to build a balanced portfolio is a lot of work. It's a lot of work. You have to have all the asset classes in them, which the general asset classes are cash, which would be money market funds, equities, and fixed income. But there's other asset classes. There's real estate. There's various derivative assets. There's commodities, and so on. And those, again, you're getting a little bit special in the special asset classes there. But just in the stock universe, you have to have large cap stock, mid cap stock, small cap stock, then small cap growth, small cap value, and so on. So you're talking about a matrix for just the stocks with a minimum of 9 cells in it. It's difficult to build a portfolio. Much more difficult than people think, which is why I say that a good set of indices or a good market-based index is probably the best way to go for most people. The fees and costs are low. And there's been a number of studies that have been shown over time that it's very difficult for portfolio managers, professional portfolio managers, to beat an index over time. It happens. People get lucky for a couple, 3 years. There was one case where a fellow named Bill Miller, who used to work for T. Rowe Price, beat his index for something like 17 years straight, which is a phenomenal record. The statistical chance of it happening it's astronomically low, but it can happen. But to build a portfolio is a lot of work. You got to pay attention. You got to know what you're doing. You got to adjust it. You can adjust it with put overwriting, call writing, all kinds. But for most people, most of the time, they lack that kind of expertise. Again, a portfolio built with a solid portfolio base built with indexes, in my opinion, is the best way to go. ETFs, and then you can branch out from it. You can look, maybe I want to have a little bit more here, maybe a little bit here, and then do my research. But a good set of indexes that cover a total stock market index, total bond index, and some money market fund, good cash index, or good cash component. Over time, that'll perform pretty well for you. It's a good starting point for most people. And as I said, then as you become more sophisticated, then you can add and subtract, adjust it.
Yeah, I mean, I actually read a study recently. They said over time, since 1928, I think it was, the S&P has been averaging about 12%. I mean, over all those years, which compounded after all those years, that's going to be pretty good for you. I mean, if you start early. And
the question is, you got it. Okay, that's 12%. Now, is that before tax and before inflation? But even if you take inflation and taxes out of that, okay, it's still going to be outperforming most assets. And that's my point. There was a study that was done. I can't quote the authors because I frankly don't remember them. I think it was Brown and somebody else. But anyway, there was a study that was done a number of years ago that indicated that well over 75% of the returns in a portfolio is not necessarily the stocks that were picked or the bonds. It was how the portfolio was allocated. In other words, 50% stock versus 60% stock, 50% fixed income versus 40%, that kind of thing. So that's what I'm saying. It's get the indexes, figure out the percentages you want to have for the indexes, rebalance once a year, maybe quarterly if you want to get a little neurotic about it, but I think that's excessive. Maybe twice a year, but certainly once a year. But for most people, that's what I would advise. And I just saved you a lot of money by telling you that. Because that's what most advisors are going to do anyway, frankly. Right.
I mean, the same type of thing. Do you like a Roth IRA too? Like, is that pretty solid option?
I would advise people to have IRAs. I have IRAs. I have various components. I think most people should have, again, depending on how you want to have the hit. When you retire, you want to have tax-free income. For most people, it'd be IRA advantage. Some people like to have the cash up front. They just want to have the regular IRA. Kind of depends on your perspective. I like the tax advantaged IRAs.
Yeah, definitely. So the last question I have for you, it kind of goes back to like the crypto thing. What did you ever hear about like the NFTs, all that stuff going around? What did you have to think about all that stuff?
Well, it's an interesting asset class.
Yeah.
You could. I don't know that having an NFT hanging on my wall is all that valuable because people like to have art. I don't delve in it. I know about it. I don't necessarily recommend it, but everyone has different tastes.
Yeah. Right.
If you don't know much about it, again, I'd stay away from it. If you think you know a lot about it. If you think you're an expert, then be my guest. But I don't partake in it. I don't have any plans on it.
Yeah, that was for me. That was I bought one, and I was like, why did I buy this? It was a terrible investment. But I did my research, and I was like, I felt really good about it, and it, bad investment.
Then it's a learning experience, and take it that way.
Yeah, that's I mean, it's a learning experience for me. It was a lesson. I'm like, okay, I've learned, but now I have a picture of a little animated monkey I'm like, well, I have it now. I guess I'm the only person in the world who technically owns it. So
well, something might be worth $1 million.
Yeah, right. You never know.
You take that as a lesson, right, Sam? Okay, because we all make bad investments. We all do stupid things or rash behavior or what have you, however you want to describe it. And that's okay. We're all human. We all do that. That's how you learn. If you don't learn from your mistakes, then you shouldn't be investing. Have somebody else do it for you.
Right.
If you learn from your mistakes, that's a valuable experience.
And I've actually I've been sticking with the options. I'm just trying it, just learning about it, just trying it. And what I've been doing for the most part has been trading on like Investopedia, where they give you the cash. Right. And I've actually traded with a little bit of my own money too, not much, but I've made those mistakes. And like, overall, like I've learned, and, it's really helping my growth towards getting better at that. I know what to do, what not to do, and I know what I need to learn basically. Like, it's very, very helpful actually getting the experience and actually getting the mistakes and like having that feeling of, oh, I just messed up, I just lost money. It's very beneficial, I think. That's how I look at it.
It is, and be careful with derivatives. They can be reckless or conservative, depends on how you use them. I'm a fan of them, but you got to know what you're doing.
Yeah.
But be careful with them. I would stay away from futures, even though they can be very conservative. I'd still be very careful with them because they're mark to market. They can really turn against you quickly. With the options, you know what your loss is going in.
Right.
The CME is a good website, a lot of educational resources there. I'd look at that.
Definitely. Yeah, definitely. I've actually used CME quite a bit. And yeah, I'm right now, I outside of what we've done in class, like I know nothing about the futures market. I'm just like, I'm staying clear of that.
Yeah, I would avoid that. And, the professional traders, I would avoid the futures. Again, I like futures. I'm a fan of them. I think there's a very useful purpose for futures and forwards contracts. But for an individual trader, unless you're in the pits every day, I'd stay away from them, frankly. Options are a little bit different story, but they can be dangerous too. You have to understand what you're doing.
Yeah, that's just the biggest thing. You can't go in and just expect to win right away. You got to do research. You got to have the experience. You have to know what you're doing. And yeah, that's the biggest thing. I see a lot of people who are like, I'm going to try this, and they lose $500. I'm like, well, you can't just, I'm going to try this. You got to put forward research. You got to do a lot before you can just jump into a call or a put, like there's a lot that you have to do.
Well, there is, and you can still lose your money with the research. But again, if you take that as a learning experience and get something out of it, even if you say, I don't want to do this anymore, well, that can be a pretty cheap lesson too.
Right. And the biggest thing that I've learned too is, you can do all the technical analysis too, but sometimes that's not even gonna, be accurate. Like we said earlier, no one can predict. If you find someone that says they can predict the stock market, you got to run away. Like
that's right.
It's impossible. So, it's always, what I've learned too is instead of trying to predict, you try to react, and try to figure out what to do based on what's happening rather than what you think is going to happen. Because you're probably wrong if you think, something is going to happen over time.
I think that's a good statement, Sam, but I would also add to that try and anticipate, try and be proactive instead of just entirely reactive. The people that do the best in the investing world are proactive. They don't necessarily, again, I go back to what I said a few minutes ago, the crystal ball isn't any better. Okay, but they do tend to, they anticipate a little bit better. Okay, and I really think that's just a function of putting the time into doing the research. Nobody's perfect. Nobody's going to get it right, at least not all the time. But if you do the work, you have a leg up on people that don't. You at least have a better chance. You're going to increase. Chance favors the prepared mind. And that's a famous quote by Louis Pasteur. And that's not the whole quote, but it's embodied in the quote. So chance favors the prepared mind. Take advantage of the quote. He's trying to tell you something 200 years ago.
Yeah, I think that quote, that's like anything. You can use that for anything,
Yeah.
Prepared, you got to take advantage of it. But, well, thank you. I really appreciate you coming on and talking to me. This has been really awesome. I've learned quite a bit here. And so I really appreciate it. So thank you for coming on.
Well, thanks for having me on, Sam.
Yeah,
I appreciate it.
Absolutely.
It's a good time.
Yeah, absolutely. And thank you guys for watching this episode. I hope you guys learned something. Hope you guys enjoyed that episode. And remember, we're on Spotify. We're on YouTube. And actually, go follow my Instagram too, keepit100podcast.ig. Go check it out there. We got snippets and clips and news and all sorts of things on there. So go check it out if you haven't checked that out. With that being said, thank you guys for watching, and we'll see you guys in the next episode.